Good afternoon. It's 1 o'clock on Thursday, the 3rd of September. This is the Wall Street crossover show sponsored by Admiral Markets and starring their market commentator Darren Sinden. Good afternoon, Darren.
Afternoon, Zach.
Right, we're in the heat of battle here. The ECB have just announced that they're not doing anything on rates, but it's a press conference, as you were suggesting to me before we came on air, which is important.
Yes, that's coming. That will start, I believe, at 1:30, so after we're finished. But it's what they're never going to say anything too dramatic in that headline about rates. We didn't expect to cut rates. What we're looking for now is clues from Mr. Draghi about the things we discussed yesterday. Whether he's going to up the amount of QE, whether he'll increase the pace, maybe be a bit more focused in terms of which bonds he buys, etc., etc. Maybe he'll announce another round of the TLTROs, the targeted lending and repo. So
a lot of things could actually happen from 1:30 to 2 o'clock.
Yes. In terms of I mean, he may say nothing and leave it as the status quo, and markets will have to interpret that as they want to. So
right.
there'll be a lot of people paying close attention to what he's got to say.
Okay. Well, let's go on. Let's go back in time to the data released over the European session.
Okay. Again, a fairly full calendar today, so I've just picked a few highlights out. First of all, it was UK services PMI data released this morning for August. Rather disappointingly, given that the service economy seems to have been doing the best in the UK, we got a read of 55.6, sharply lower than the forecast 57.6, and well below the prior read of 57.4. So that's probably not the news that either the Bank of England or George Osborne would have been looking for. I don't know whether there'll be some seasonality attributed to this.
George Osborne, obviously, it was a kiss of death when he said that the UK economy is motoring.
Yes.
So it's motoring in a very slow fashion at the moment.
Yeah, I mean, obviously, having said that, of course, we're still very, 55.6 is still well above, the 50 contraction level, but nonetheless, you'd like to see an ongoing positive trend. And if we move into Europe, where we might have expected some depressing news, we actually got some small positives. Europeans, or Eurozone services PMI, I should say, for August came in at 54.4, modestly ahead of both the forecast and the prior read of 54.3, so something there perhaps to make Mr. Draghi smile. And more to the point, he can also look to the composite PMI, which is the manufacturing PMI plus the services PMI, the blend of those two, and that read for August came in at 54.3. So again, well ahead of the forecast of 54.1.
That's all quite good, really. I mean, all the moaning and groaning that we've had. I mean, it's not too bad, especially compared to the UK.
Oh, it is good, and it's surprising, isn't it? Given some of the disappointing data that we've talked about on here. Amazing what happens when these things are
But as a whole, it seems to be Europe is actually not that bad. It's just the particular. France is a bit dodgy, and but Spain is good. Germany is obviously still the powerhouse, etc. So it's the average is not.
No, the average isn't bad. There are just pockets that don't seem to be responding, and that's something he might need to address today.
All right. Okay. Next slide.
Okay. So European movers. First of all, stock we talked about on a number of occasions on the show, but Syngenta in Switzerland, SYNN there. Up around 3.3% at 337 francs 80. Viewers will recall that they recently were bid for by Monsanto and wanted nothing to do with it, and the share price fell sharply. So the management's moved to try and give a sop, I suppose, to shareholder concerns. They're going to put their vegetable seed unit up for sale. That's worth about 4% of the company's revenues, around, I think, 660 million of annual sales. And they've, perhaps more important than that, they're going to return more than $2 billion to shareholders through a proposed share buyback that could kick off as soon as a couple of weeks' time. So that seems to have been
quite dynamic.
It is, but I mean, it's obviously a long way to go, because they fell to 25%, I think, on the news that's in Monsanto.
380 or something that was on the table.
Thereabouts, yeah.
Yeah.
If not higher, actually. Rio Tinto. Actually, I think it's more like, coming back to that, I think it's more like 449, if memory serves.
Right, so basically they've got a lot of work to do.
They have, yeah. Right, Rio Tinto, moving back to the UK into the mining sector. Ticker RIO, one of the largest mining companies in the world, obviously having a tough time of things lately, but £23.30 they're trading at this morning, up 2.8%. And the reason is that in a briefing to analysts and investors, the company has posted an upbeat forecast for its iron ore outlook. It says it sees global steel demand growing by around 2.5% on average per annum for the next 15 years, and it's quite upbeat about how it can take advantage of that. So that's probably a bit of a contra view on iron ore. But
well, it's small crumbs of comfort if you're a shareholder. I mean, the shares are still right down at the bottom, aren't they? So
yeah, they are. But I guess they're trying to make the best of a bad situation. But nonetheless, it's a while since we've had some actually positive news outright from the mining sector, and that was an example of that.
Okay, let's go on to the M&A rumours and movers.
Okay, well, we touched on this a few weeks ago, the idea that having seen quite a fair bit of consolidation amongst the cable, media and telecoms companies, we might also now see some moves in the area of content. And the US film and TV studio Miramax has hired investment bankers Morgan Stanley to find a buyer for the business. Thought to have a sale price of at or in excess of $1 billion. And the potential buyers for the business will be people like Netflix, that's ticker NLFX, Hula, or Amazon, AMZN, as well as rival film studios and cable TV operators. Miramax was previously sold by Disney back in 2010 to a consortia that included the Qatar Sovereign Wealth Fund, and they paid around $660 million for the business then, so they would be selling at small profits over that time. Miramax has a strong back catalogue, but since it's separated from Disney, it's not necessarily had that many big hits, so it's really trying to re-establish its current franchise. Nonetheless, it probably does make an attractive proposition at a relatively cheap price for that industry, and it will be interesting to see who lines up to bid. It's also interesting to note as well that the papers are full of stories today that Steven Spielberg is looking for a new home once his contract with Disney expires any minute now. So there's a real potential for some big deals to be done in this space going forward.
He's a new hit as well, doesn't he?
Well, he does too, but
it's good timing in the sense that the streaming services are looking to become content distributors,
and creators in their own right.
Exactly. So it is a good idea at face value. Right. Let's go on to the US data points.
Okay. Well, there are several big data points in the US today, but I picked out international trade, i.e. the balance of trade for July. Forecast is for a deficit month on month of $42 billion, but that's a bit lower than the June figure of 43.8 billion. Whilst the dollar's relatively strong still, we'd expect the US to be sucking in more imports than considered exports, but this does seem to be heading, if you get numbers like this, would seem to be heading lower and in the right direction. And then probably the number that most people will be watching closely today, weekly jobless claims, and the reason for that obviously is that, as we said several times this week, we've got the bigger employment number, the non-farm payrolls tomorrow. So we're looking for a forecast of around 273,000 new claims this week versus the prior read of 271,000. Basically, the figure has held above 270k for the last 4 weeks. It's missed either side of estimates, but it's sort of stayed above 270. It probably would be, of course, more bullish for interest rates if we saw a figure well below 270, but remains to be seen if that will be the case.
Okay, let's go on to the US pre-market movers and levels.
Okay, well, the first one is actually something that caught my eye yesterday, but I thought it was worth mentioning. Level 3 Communications, LVLT is the ticker, closed yesterday at $45.12, up 4.32%. Just wondering if it might have a little bit more to go this afternoon. The reason for the move is that the voice and network communications services provider was named the top telecoms pick at Citigroup. So quite a positive recommendation for the stock there. And then moving to the world of pharmaceuticals, Lannett & Co., that's ticker LCI in the US, $59.25, up 19.75%. This is quite an interesting one because they're sharply better because they've announced the purchase of a rival company called Cremer's Urban Pharma, which is a generic drug manufacturing company. What I think the market's got behind here is that Lannett have said that this deal will be earnings enhancing almost straight away, high single-digit figures for next year, and in 2017 they look for the deal to add 20 to 25% gain to their EPS as a result. So,
and the market loves pharma stocks at the moment. Anyway,
they love pharma stocks, and they love a growth story with tangible figures like that to hang their hat on. In terms of equities, a little bit better in Europe this morning, though nothing to get too excited about. But we are able to change our ranges slightly. So for FTSE, 60, 86,080 if you prefer, plays 6,200, the downside and upside levels. For the DAX, 10,145, plays 10,273, so slightly tighter than yesterday. In US equity indices, again, there were modest gains, but 1940 plays 1965 now in the S&P. And for the Dow, 16,300 plays 16,460. We can't tighten that Dow range any further, unfortunately, just because of the nature of the candles that we've seen of late. Currencies, not too much change as far as euro dollar is concerned, so we stay with 112.18 on the downside, plays 112.58 to the upside, just tightening the range slightly there. Aussie dollar, US dollar, we did test below 70 yesterday. So we've nominated 69.80 as a downside level, just below yesterday's low of 69.90. And then to the upside, we'd need to see a move back above 70.30 if we had to stage any sort of sensible rally. Dollar yen, as we said yesterday, seems to have settled around 120, so 119.90 on the downside for now, plays 120.66 to the upside. Thankfully, cable seems to have
stabilised.
Yes, so 152.33 we'd say on the downside for the moment, plays 152.95 to the upside.
Okay, well, let's go on to what you got in focus, which is a topical item.
Well, yeah, just really what we're watching at the moment is just wondering how quickly US equities might recover. I can't claim any credit for the data here. Tip must go to Morningstar Research and StockTwits for this, but just run through the slide. So we saw some significant falls in US equities during August, and the moves were sufficient to be included in the top 6 5-day falls, according to this research from Morningstar and StockTwits. And here we're looking at the Dow Jones Industrial to Dow 30, just for the avoidance of any doubt. And the question we ask now, of course, is how quickly can US equities recover, if at all? And the top of the table shows us these top 6 significant falls. Black Monday, note 87, we fell 29.6% in 5 days. The Russian default, 12%. You can see 9/11, 14.3, etc., etc. And the bottom part of the chart shows us the amount of time that it took for the Dow to recover. 419 days to get back to where we fell from, as far as the 87 crash was concerned. Much more quick recovery in terms of, say, 9/11, where we only took 40 days, and a similar length of time for the Russian default in 1998.
So it could be like a couple of months, probably.
Well, it could. I think what we've got to try and decide is whether it's a localised event or whether this is something that's more global. One interesting thing I think to point out is that some commentators have referenced a relatively modest revenue stream for the S&P 500 from China as a whole, and the research from Bloomberg and Goldman Sachs suggests that accounts for just 2% of total revenues for the S&P based on 2014 data, which could suggest that the moves in the US equity markets were more sentiment-led than actually based on cold hard data. That would imply a quick rebound, but of course, as we know, we were at the end, or coming to the end perhaps, of the third longest US equity market rally, and also we're on the cusp of rate rises. So I wonder if the local factors might have more to say about the recovery than
yes, I think that's the thing. There was nothing really sort of positive to latch onto in terms of looking away from China, and also China in a low growth environment, which is where we are. That was one of the beacons of being high growth, 7% and everything else to lead the world on. So not totally cheerful there. But anyway, we'll see what happens. Hopefully 1 to 2 months is the average on this situation. That's it for the Wall Street Crossover Show today. Darren Sinden, market commentator, Admiral Markets, thanks for coming in, and we'll be back tomorrow at 1 p.m.